Now let's move on to the third session, which is a presentation given by Cherry Chan, a partner at Barnett Wardenham. To give you some background of Cherry, since 2013, Cherry Chan has been a partner and the head of general insurance team at the Barnett Wardenham, an actuarial consultants firm in the UK. Prior to joining Barnett Wardenham, she has worked at Deloitte and Marsh. Cherry has 20 years of actuarial experience, having qualified in 2004. She holds a practicing certificate for non-life, non-Lloyd's insurance in the UK. Cherry has experience in advising a range of general insurance companies on actuarial issues, including statutory reserve reviews, pricing and Solvency II implementations. Her latest passion is to help insurers find ways to improve innovations and make actuarial processes more efficient with the use of technologies. She has also been recently elected as a council member of IFOA, where she's keen to help the IFOA push forward the digital strategy. Now, with no more delay, please allow me to pass it over to Cherry.
Thank you, Xuyan. Let me share my presentation first. So I hope you can see it now.
Yeah.
Yeah? Okay.
Yeah.
So yeah, good afternoon, ladies and gentlemen, or good evening to some of you in Asia and maybe other parts of the world. Thank you, CANUK, for inviting me to take part in your annual conference. So also a big thank you to CANUK for supporting my IFOA council election in May time as well. I am very grateful for the support for you in promoting my candidacy to your members. And it's my pleasure today, to give you a whistle-stop tour on the impact of COVID-19 in the UK. Well, the pandemic has literally changed everything in our daily lives. As you can see, we are now doing a virtual webinar rather than an in-person conference. So there are so many topics that I can pick from, but I only picked a few today due to the time constraint. And hopefully I will be able to give you a flavor on each topic on how the pandemic has changed this industry. And if there's anything that you want to find out more, then I'm more than happy to follow up with you after today's conference. So this is today's agenda. So you can see that I will set the scene first by giving you a few economic indicators in the UK, where we're at and where we are heading. Then I'll discuss some of the topics that I hope you'll find interesting. For example, the number of COVID-19 deaths, impact on the insurance and pension industry, and why I believe risk management is more important than ever so. So let's move on to the UK economic indicators. I have looked at UK's GDP inflation and unemployment forecast for this year, just to gauge the outlook of the UK economy. There are, of course, other indicators you can look at, but just by looking at these three, you can tell that they aren't looking very good. So the IMF, International Monetary Fund, has predicted in June the UK GDP will shrink by 10% this year. In the first quarter of 2020, UK's GDP fell by 2.2%, but the full effects of coronavirus are only starting to show in quarter two, where GDP fell by more than 20%. Recession is defined as 2 successive quarters of declining GDP. Therefore, UK has officially entered into recession for the first time in 11 years. The last recession was triggered by the global financial crisis back in 2009. So it lasted for 6 quarters. But the good news is that the Bank of England predicts that this recession will recover more quickly, despite being more gradual than initially anticipated. So in fact, we have already seen some signs of growth in the recent months, when the lockdown measures were eased. So the IMF is projecting a growth of 6.3% for the next year. But of course, UK recovery will also depend on whether we can reach a trade deal with the EU and when. And So here's the Bank of England's long-term inflation. They're targeting at 2%. And we've seen that it's been fairly stable between 1.5% to 2% before the lockdown. But since March, it has plummeted down to below 1%. So between April and June time, it's around 0.5 and 0.6%. But then it recovered slightly back to 1% in July. And a sharp reduction in economic activity in the UK and around the world has led to a reduction in demand and collapses in oil prices, clothing, transportations, etc. So the outlook for the economy and inflation is unusually uncertain, and inflation may remain low for some time. And on unemployment, there you go. The unemployment rate is fairly low at 3.9% at Q2. I will discuss more on this number in the next slide. The OECD predicted that UK unemployment will peak by end of this year because UK is more exposed than other countries to the global slowdown in trade. One reason of this is due to UK companies cutting more white-collar administrative office jobs in recent months much faster than other countries. And if we experience a second wave, the number of unemployed people in the UK could soar to nearly 15%. As you can see, I've highlighted the UK numbers in yellow. And this will take UK to a higher level than France, Germany, and Italy, but lower than Spain, because I think Spain got lots of different issues themselves. So I'll come on to, why is the UK unemployment rate so low at 3.9%? Initially, I was surprised at how low this was. Then it became apparent that because the UK government introduced job retention scheme back in May. And as you can see in the graph, by the end of July, there were a staggering 9.5 million jobs furloughed, costing the government £32 billion by the end of July. Plus, there's another 2.7 million self-employed, claiming income protection, which is costing the UK government another 7.8 million. So these schemes, plus reduced hours for some workers, and increasingly more people are not actively looking for work during the pandemic, all contributed in keeping the unemployment rate low. But for now, the job retention scheme and self-employed help are coming to an end in October this year. So this means the unemployment rates may shoot up as companies are downsizing or become insolvent afterwards. So next is, many of you may have been like me. Since February, I was watching the news every day to monitor the number of new cases and also number of deaths, first in Asia, then in Europe. So we as actuaries like to look at figures. So I looked into the number of deaths in a little bit more detail. So the way UK government account for number of COVID-19 deaths have changed a few times since the pandemic began. Here are a few figures that all represent the number of COVID-19 deaths at the end of July or at the beginning of August. Which one is correct though? I'm not sure. But my conclusion that is measuring the number of 19 deaths isn't an exact science. The latest change in the count is based on a new definition of who has died from COVID. Previously, people in England who died at any point following a positive test, regardless of cause, were counted in the figures. But they are now a cut-off point, meaning that only those who has tested positive and died within 28 days of a positive test will be counted. So this cuts down the number of COVID deaths by more than 5,000 in August. So you can see the number dropped from 46,706 to just over 41,000. So CMI, who produced the UK live tables on behalf of the IFOA, has also weighed in this discussion. They have been producing reports on number of excess deaths that could be contributed to the pandemic weekly since week 13, so that's end of March. They estimated around 61,000 excess deaths as at 24th of July, which is substantially higher than the UK government's reported figures. So I'll go into the CMI figures in a bit more detail in the next slide, as they're produced by my colleagues at Barnett Waddingham. So CMI has used the 2019 mortality rates as the base rate, because 2019 and 2020 mortality rates in the first 12 weeks are very similar. So the excess death rate is calculated based on the 2019 mortality rates with no mortality improvements assumed. So this chart 3 is from the CMI week 30 monitoring paper. The gold line is the number of registered deaths where COVID-19 was mentioned on the death certificate. So the blue line is the number of excess deaths over the expected deaths in each week since week 13. And the number of excess deaths was much higher than the number of deaths where COVID was mentioned on the death certificate between the week 13 and 17. So this is between the 23rd of March that week to the 20th of April that week. But this is not the case in the later weeks. And you can see the excess deaths actually turned into negative from week 25. So I find it very odd. But there are two reasons due to the negative excess deaths. One is what they call forward mortality displacement. So which means those deaths would have happened in later weeks if the pandemic did not happen. So in the other words, pandemic accelerated some deaths. And the second reason could be is an indirect impact of restrictions on movements. So for example, lower traffic or other activities which cause less accidental deaths in the later weeks. So now move on. Well, I need to put on a CMI disclaimer for using their numbers. So I'll move on to the insurance industry. So when I say insurance industry, it encompasses life, general, and health insurance. General insurance is sometimes referred to property and casualty, or P&C. So firstly, on the life insurance side, excess deaths have caused more claims activities. But as I understand that, there's relatively little impact on the reserves at the moment. And it is unclear how mortality rates may change in the future. Even on the asset side, stock market and credit spread has recovered from initial shock. But if you look at the underwriting side, some life insurers are now asking COVID-19 related questions and may defer cover if the customer has tested positive recently. And on the health insurance side, private medical claims are down this year because elective procedures are not taking place and no one wants to see a doctor if it's not urgent. So this led to some health insurers giving premium refunds to the customers. But claims on the income protection side has increased slightly though, due to higher sickness rates. And I don't think anyone would have guessed that at the beginning, that general insurance industry would be this, the area that has been hit the hardest during the pandemic. And back in May, Lloyd's of London said they were likely to pay $3 to $4 billion in insurance claims related to the pandemic. This is similar to losses from the 9/11 attacks. And they also estimated that the market loss could be as high as $200 billion. And the impact on individual lines of business do vary significantly. And I'll show this on the next slide. So I have to put out a disclaimer first. These are just my personal views and it should not be used for any calculations. So the most obvious lines severely impacted by coronavirus are travel and event cancellations. You know, for very obvious reasons that loads of or thousands or millions of holidays were cancelled and many events were cancelled as well. Cancellation of Wimbledon tennis this year costed the insurer over $200 million. And luckily, the Olympics were only postponed rather than cancelled. If we were to cancel this, it would have cost the insurance industry another $3 billion. And trade credit is also hit by companies struggling during the pandemic. And therefore, payments are more likely to be default, and hence more claims will incurred. And in June, the UK government announced that they would guarantee up to $10 billion of trade credit insurance coverage on a temporary basis for 9 months, backdated from 1st of April and running till the end of this year. Property and business interruption is an interesting one, because there are lots of discussion and court cases going around the world on whether insurers should pay out business interruption claims due to closure of their businesses from pandemic. Policyholders expect the insurers to cover them. However, insurers said that policies were never intended to cover pandemic-related losses. The policy wordings were far from clear. So I can see why policyholders can interpret it differently to the insurers. The situation is complex. Legal wordings are always open for interpretations. So therefore, the UK Financial Conduct Authority went to the High Court in July to try to get some clarifications on whether non-physical damage business interruption claims should be paid. However, the verdict won't be due before mid-September. And even if insurers lost in the court, they could appeal to the Supreme Court. So it could still take a while for this issue to be resolved. So which is not ideal for policyholders who need the money now. Liability claims, such as employers' liability and public liability, may increase in the future. The market view is there may be more liability claims due to employers being sued for not having proper procedures in place to prevent spreading of COVID at workplace or protecting the employees' safety. But I haven't seen evidence of claims going up yet. So maybe others who work in the insurance company have seen something differently. So for the next three classes like motor, marine and aviation, the volume of traffic for these classes have dropped dramatically since the beginning of the pandemic. So the claims activities are much lower than before. But it's not always good news, because some insurers have given refund to policyholders due to the inactivity. And with economic outlook remains weak for the remaining of the year, premium volume for these classes may drop significantly. So with a high overhead cost to cover, insurers writing these classes may face difficult times. Also, for many operators, they have their coaches, bus, ships, planes grounded. Keeping up the maintenance of these vehicles when they're not used are very challenging. So my final class is cyber risk. The risk may be higher because the perception that is, when people work from home, they may be less vigilant to phishing attacks, and they might be more likely to click on things that they shouldn't have. So hackers might be more likely to hack into company system, but I'm not sure if this will translate to insurance claims or not.